Joining us now is Jefferies chief market strategist and CNBC contributor David Zervos and Unlimited CEO Bob Elliott. Guys, happy Friday. Bob, you say the big money, some people call it the smart money, hedge fund manager conviction in the stock market near historic lows. How does that get reflected in the stock action on a day like today when we got these two significant signals?
Well, I think the biggest thing that money managers are seeing is that the rise in interest rates that is reflecting the strong growth of the past is undermining the strong growth to continue in the future. And that's happening at a time when you see expectations of growth in the U.S. economy about as strong as they've been in many years. And so this economy is doing pretty well, all things considered, but not so well that it could face 100 basis point market-based tightening and continue to thrive as much as it has the last few years. And that's really, when you look at that set of conditions, we're teeing up for 25 likely being a pretty big disappointment.
Okay. Well, David Zervos, you're still bullish risk assets in this environment because you think rates are still headed lower. Why?
Well, I don't think I'm alone in that. I think Governor Waller was talking about that this past week, and we've been writing about it. I think a number of people still have that trajectory. Certainly the Fed has that trajectory. This was a strong number, John. There's no question about it. And when we get a strong number about the economy, even when there's not an inflation story to it because the wage side was actually quite contained, and you get a 2% move down, I think something else is afoot. And what I would argue is that the market is struggling a little bit with this idea that the Fed is possibly going to make a mistake and stay a little bit too restrictive. And the data are going to come in strong, but really what's baked in with all of the rate hikes that we've had, the balance sheet contracting, is that policy is going to get restrictive and they're going to get a little bit behind here and stay too restrictive for too long. I think that's why you got the curve to invert a lot today. I think the 2-year note was up 11 basis points. The long bond barely moved. That's not a sign that there's inflation expectations. That's not a sign that people are worried about Fed credibility. That's a sign that they're kind of going to stick around at high rates for a little too long and maybe make something a little bit more negative for the economy happen. I think that's what the market's getting a little bit jittery about. Okay. And also the politics matter there, Morgan.
Okay. I want to get your thoughts on how you would be positioning in this market right now, given the fact that I do hear the caution from you. And I guess just as importantly, would you say that the bond vigilantes are back in this market?
Well, I think naturally what happens is that rise in yields creating the prospective economic slowdown then necessarily creates the bid in bonds. And we've seen this a few times over the last couple of years. You get to rates that are a little bit above 450, stocks start to sag a little bit, rates go a little bit higher, you get towards 5. And, that's basically where the bid is. And odds are we're going to continue to see that. And given the significant strength that's priced into the stock market, right now this is a time to favor bonds relative to stocks. And today may be, the first of many days along that dimension.
David, do want to get your thoughts because I know you're basically making the argument that at some point you're going to see yields come down and maybe come down meaningfully. So you see this as a buying opportunity here? And if so, what would you be buying?
I mean, it depends a little bit on your horizon, as always, Morgan. But, we use the bond market as a hedge to the stock market, right? We talk about our risk parity trades. We like having a levered position in the fixed income markets in case something goes wrong with our equity risk asset trade. That's really the story. And is it an outright bond trade? I'm not advocating that. I certainly think we could trade north of 5%. There's no issue with that, but I don't think that's where we're going to be over the medium to long run. I think the story that happened today, and I'll reiterate this from the previous comments, is that the market is getting nervous that the Fed is going to stay at too restrictive a level for too long. There's politics involved in that. And the data, when it's stronger, means that they kind of have an excuse to do so, even if the forward parts of the data look like they might be weakening. So I think it's not a big move, but I think it's important to note today the 30-year bond yield didn't really move that much. That's not a sign that people are losing faith in the U.S. government bond market. They're buying 30s over 2-year notes. They're slamming the front end. That's changing rate expectations. That's changing the narrative on Fed cuts. And that's getting the market nervous that the Fed might be mistaken down the road at staying at these rate levels, these high rate levels for too long, much like they did in 2018 when Jay Powell and Donald Trump were having a little bit of an argument about what the right rate level was.
We were just talking about 2018 with you last week. Here we are again.
I think we were. I keep bringing it up. It was not a fun time, and I think we got a little messy because of it. But I don't think we're going back there. By the way, I don't want to be that pessimistic. I certainly don't. But I think there could be a little fight brewing.
Yeah.